From the morning reading, Spiders, Qs, and IWM end the quarter with a monthly new high close. 8 of 10 sectors moved higher on Friday. XLF, XLV were the strongest sectors, while XLU was the weakest sector. Oil futures rose 33 cents to close at 48.05. For the week ended September 30th, 6 of 10 sectors moved higher. XLE was up well over 4%, XLI up over 1%, XLB just below 1%, XLK 0.61%, and XLY about 0.5%. The Spider was up fractionally at 0.14%. In terms of the year to date at this point, and we now have 3 quarters in the books, XLE is up over 17%, XLU is up over 13%, XLK up over 11%, XLI up over 10%, XLB up just below 10%, and the Spider is up about 6.1%. Lagging sectors on the year to date would be XLP, up a little over 5%. XLRE, our new real estate sector, is up over 4%. XLY, 2.4%. XLV, 0.11%. And the only sector that's negative on the year to date is XLF, financials, minus 0.26%. With Friday's action, breadth strengthened compared to the prior session as advancers led 2153 to 895 in the New York Stock Exchange and led 2056 to 756 on the NASDAQ. Also in the morning reading, the S&P 500 snapshot, it was up fractionally for the week, but down 0.12% for the month. Deutsche Bank shares rebounded on Friday, and the U.S. equity markets followed suit. The S&P 500 opened at its 0.25% intraday low and rallied through the session to its 1.12% intraday high early in the final hour. Some selling shortly before the closing bell trimmed the Friday gain to 0.80%. The index finished the week with a fractional gain, but the month of September closed with a fractional loss of 0.12%, the second consecutive 0.12% monthly decline. The yield on the 10-year note closed at 1.60%, up 4 basis points from the previous close, but down 2 basis points from the previous weekly close. Also in morning reading, defensive sectors have been the best performers so far this year. Through September, the most defensive sectors have been the most consistently good performers, while the most economically sensitive sectors have lagged. If we create a score that ranks the performance of the sectors through the third quarter, we see that 2016 ranks among the most extreme. When that's happened in the past, fourth quarter returns were okay, but much below returns when the most aggressive sectors had led through September. Aggressive traders are betting on a fall in crude. Most leveraged ETFs in the market that bet on a fall in crude saw a record flow on Thursday. Financials lead Friday's stock bounce. Deutsche Bank leads European banks higher. The Bank of America and Citigroup leads U.S. banks. Transports are on the verge of a bullish breakout. Rails like Union Pacific and CSX have already turned up. Friday bounce in yields weakens utilities and REITs. S&P 500 tries to reclaim the 50-day moving average. The S&P tries to regain the 50-day line. The stock market rally on Friday puts the S&P 500 in position to reclaim its 50-day moving average. It also keeps the SPX well above chart support at its mid-September low. The 14-day RSI line is still trying to clear its 50 line. The daily MACD lines have turned positive from chart support at their June low. With September nearing a close, stocks are entering a more favorable seasonal period during the fourth quarter. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:21 a.m. Mountain Time, and I'm recording this in preparation for the market day of October the 3rd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into our morning report. And you'll see that on all four U.S. broad-based indices, they're all just below scratch at the time of this cut. Nothing of significance has happened in the Sunday night market. And crude oil, we're up about 2/3%. Euro's down just below scratch. Bonds are up just above scratch, and gold also just above scratch. And foreign markets that we track, notice that China and Germany are not open. So we got Hong Kong up over 1%, Japan up just below 1%, United Kingdom up over 1%. And Monday's U.S. macroeconomic reports of note, we have ISM manufacturing PMI. And that looks to be about it for the United States. A full slate of stuff going on in other places, though. And looking forward to tomorrow, I don't see anything of note for the U.S. schedule. So pretty light start of the week and start of the month from a macroeconomic report standpoint for at least U.S.-centric. In terms of the current volatility conditions, you see short-term VIX at 12.37, skew also benign. IV percentiles are also still quite low, though not quite as low as they have been in recent weeks. On the S&P at 22, the Russell 13, the NASDAQ at 18, the Dow at a 23. We did have positive standard deviation moves put in on all four of the U.S. based indices on Friday, but you see last week was a pretty hot week. In the 5 days, you had 4 with standard deviation moves going both directions in 4 of the 5 indices, and 3 of the 5 days were standard deviation moves in the S&P. So most notably, you notice the Russell here, you went +1 standard deviation, -2 standard deviations, +1, -1. I mean, there was a lot of movement going back and forth. I mean, we'll bounce to the charts now. A lot of it just simply ended right up where it started from. And we'll dial in here to the most recent price action. You see a lot of back and forth, and indeed we've had this triangle or wedge drawn here of late. And you see with Friday's action, we actually poked our head up through the top of the wedge, but then were summarily rejected and sold off into the close. So clearly this is one of those reasons why we look for a confirmed close to get a breakout from a chart pattern, especially an intermediate term chart pattern, and even more so when you see yourself inside a neutral pattern such as this cloud formation. You really do need to see a confirmed break in a pattern, and even better, frankly, that we get a break above the cloud and what they call cloud breakout, and then that would also be above this horizontal resistance. So certainly it will be of note if we close above this wedge, but I would be even more enthused about that sustainability of that pattern if we had a close above about 2173. A close above 2173 would bring the former highs back into play, and I would expect that we would move up into that area. Right now, it's absolutely neutral as neutral can be. When you look at Dow, very much the same kind of pattern, very, very neutral action. NASDAQ also been in last week at least a short-term sideways pattern, though its more intermediate term pattern is more bullish than the S&P and Dow, and that continues to be true. Short-term action here you see, and remember we were talking about the -2 standard deviations and the +1 standard deviation. Just a lot of bouncing back and forth just to end up largely back where we started. And indeed, so here's the beginning of the week. We opened here and we closed, there. I mean, just essentially right on top of the price that we opened at for the week. But during the course of the week, we just zigzag back and forth just to end up essentially no significant difference. In crude, there was more significant action going on there. Short term was quite bullish, and we'll zero in on this action. You notice quite a bit of a move here. You notice the bodies started to get a bit smaller, but then this most recent body from last night, again, taking off, and we saw that in the morning report. So likelihood is we're going to come back into this former swing high at this point. So if you're still in a position long on crude, you might be thinking about exiting in front of that area, at least part of your position. But pretty interesting setup thus far in crude oil, and indeed the only market that's actually doing much of anything. Gold is also in a neutral pattern. You see here in the middle of the cloud. Very short term, it's been a bit bearish, but compared to where you were prior, and we've just been chattering inside this recent action. We have a larger ascending triangle pattern here, but this is a very shallow, almost horizontal type of pattern, as opposed to being a sharply defined ascending triangle. And this pattern could go sideways for some period of time, it would appear. Bonds have been coming up off the bottom, but in recent days have basically consolidated. We'll have to see where that goes. There's a lot of overhead resistance, including the clouds up above. So while this had been strongly bullish for a very long time, it certainly has given up some of that edge. And then finally, we'll finish off with the VIX. And the VIX is also in the cloud. Relatively low levels, though not super low. We're not below a 12. We always take note when we're below a 12. And this area of around 11 to 12 has been the floor really in the last 3 years, but in particular during the summer was pretty much the floor for most of that activity. And let's go ahead and go to the daily report. And in terms of market trend, intermediate term phase opinion, still market phase 4 up against resistance, various types of chart patterns up against horizontal resistance, kind of typifies that phase. In terms of our 3 market timing signals, they actually firmed up on Friday. The first one from IBD is confirmed uptrend. It's been bullish for several sessions now, and that continues. GMI index improved to 5 out of 6, with that buy signal having been in place since 9/22. And the GMI2 also firmed up. It's the more sensitive indicator. It went to a 7 out of 8. But no changes here on the decision point scoreboard. We had 3 new bullish signals and then 1 new intermediate term bearish signal coming in on the Dow. Let's go ahead and focus on the Dow here first. So short term, neutral to bearish. Intermediate term, neutral to bearish. Long term, mixed. So the Dow clearly is a laggard index. And this is our more defensive-oriented area, so this is something to note. In general, the first 3 quarters of the year, the defensive sectors have been the ones that have performed best and have performed with the most consistency. So let's go ahead and look at the S&P then. Well, the S&P had a number of new bullish signals come into place on the short term for all 3 of them, but the 500 and the 100, with the 100 being still mixed. Intermediate term, though, they're all on bullish now, with the long term still mixed. So things have improved, and then you throw in there now the NASDAQ with also alignment for the short to intermediate term at least. It wouldn't be too hard if we were to get up to the all-time highs and then break to see finally, a stack come into place on 3 of these 4. But still, you have to recognize there's still quite a few reds here, and the Dow is in a relatively poor structure here. So the overall consensus of all this is still bullish bias on the market timing signals, but yet a lot of cause for chop to continue until we get better and stronger alignment. So it's a very weak bullish bias on these market timing signals at this point. Position sizing opinions on both models still coming in at 100%. Intermediate term market posture, note first day strong bull signal. And many times we get whiplash on these signals as we see first day signals. So pay attention to this. Let's see if we can get some follow through and build on this. But the mechanical signal, which is mostly derived from the S&P, is in strong bull posture for the intermediate term. The Dow, weak bull, NASDAQ, strong bull, and Russell into weak bear. So not the best set of indicators here on the intermediate term market posture, but an improvement over what we had a couple sessions ago. Strength of trend still up over 80, but has been waning, and we see that with recent market action, a lot of choppiness. And yet at the same time, part of this you take as a reading of how likely are you to have significant weakness. And this would generally tell you that not to expect that the any kind of bear moves are likely to have any real momentum and energy to them unless new news comes in to create that momentum. But on its own, the market is willing to absorb those dips and then try to continue to push with a slight bullish bias. Hedge warning status still a 0+, normal with some cautionary aspects. In terms of strategy opinions, we haven't changed the opinion here. Still, VIX is in that acceptable window, and it is okay to initiate new positions, is the opinion for novice traders. Covered calls, still relatively conservative structure here with that 2-to-1 ratio of in the money, out of the money strikes, and 2-to-1 ratio of low beta and high beta. We're up against significant, and remember our market phase here, market phase 4, up against resistance. We're up against some pretty significant overhead resistance. Until we break out of that, it's somewhat difficult to get our postures on our trade strategies all that much more aggressive. In terms of specific warning areas, we did have a volatility ratio warning fire. And we do have this very high distribution day count on the S&P that continues to be present. In trend-based area, everything looks fine there. Key intermarket risk aversion indicators continue to be an area of concern. And 4 of the 5 are in a fairly clear risk-off posture at this point. In terms of sentiment indicators on the stock short term, a little bit elevated, and in the fear and greed index, we get an overall neutral when you add up all 7 of their indicators, and that is more neutral than we were earlier in the week. On a sector specific, you can see that with the exception of the telecom, real estate, and utilities, all the other sectors were really quite positive, both as a percent and as a breadth. So that's one of the reasons why I like this particular chart, is it shows us the participation and that it wasn't just one big company, especially in telecom where you have 2 large companies, Verizon and AT&T, that basically make up the entire sector. One company doing something can give you a very large number. You see the REITs and real estate sector struggled some, and of course utilities also have been struggling of late, though are one of the best performers for the year. And then let's go to our sector percent change and look at the how that's doing over the various time frames. You see Friday's action, but then you see the 1 week and much more mixed, and the 1 month much more mixed. So we've had a lot of chop of late, and that certainly is being reflected in performance. There's a lot of places where your investments probably haven't really gained you anything, and indeed the best performers for the month, information technology, up only 2%. Well, you'd be happy to be up 2% compared to being down 2%, but still, you know, that's not a super big charge. Certainly on the 3 month, a much stronger performance, and we have seen information technology, you know, be one of the leaders of late. Energy also has been doing more of late, and you know, and has held up as positive across all these time frames. And you see that year to date, 16%. That's the leader of all the sectors. So a couple things of interest there. In terms of market postures across the sectors, again, you know, not quite a Christmas tree, not as much red as we have been seeing, but you know, a lot of mixed signals here, and frankly, one down day, many of these could turn red again. This has really been choppy of late, and these signals have been flipping back and forth. We try to look for consistency and where they're all in an agreement, and we also try to look at where that consistency is coming from, whether it's defensive or not. And right now you have perhaps more consistency to the risk on the higher beta areas: technology, materials, industrials, energy, consumer discretionary, you know, are all higher beta areas, and are certainly showing better consistency. So we'll continue to watch that, but it's been a little bit choppy there, so hard to make too much of those signals. In terms of the relative rotation graph, you see our leaders here. We continue to be quite fond of FDN. We've been talking about that one. XBI, biotech, has also been fairly consistent performer in recent weeks, and you can see, you know, the prior week's dots here. And then also semiconductor, the XSD, and then regional banking. These are the sectors or industry groups, perhaps I should say, that are, you know, doing the strongest, best overall performance. So kind of keep that in mind as you're trying to look for whether it's an industry group and an ETF or individual stocks. You know, you probably want to look at the components of FDN and look for your ideas. Okay, that should be enough for today. We're a little over 20 minutes, so let's go ahead and wrap this up. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for tomorrow's market preview from Falcon Global. And in the meantime, manage your risk, and you'll see that everything else will fall into place. And good trading.